How just $100 a month in stocks can transform your future. The journey to building significant wealth doesn't always require large upfront investments. Indeed, the mantra of slow and steady can also apply to growing your nest egg in the stock market. By leveraging the power of compound interest and maintaining a consistent investment strategy, investing just $100 monthly in stocks over 30 years can potentially transform your financial future. Now, let's explore how this approach works and what you might expect from such a long-term investment strategy. Key takeaways. Investing just $100 a month over a period of years can be a lucrative strategy to grow your wealth over time. Doing so allows for the benefit of compounding returns, where gains build off of previous gains. Investing in such a manner also allows for dollar-cost averaging, whereby money is invested when the market is going up as well as when it is down. Making room in your finances for $100 a month to put towards investing may require careful budgeting. Understanding risks, such as market volatility and inflation, is essential for long-term investors. The power of compound interest, your money working for you. Compound interest is sometimes called the eighth wonder of the world, and for good reason. When you invest $100 monthly in stocks, you're not just accumulating your contributions. You're potentially earning returns on both your initial investments and any previous earnings your earlier contributions have made. This snowball effect can lead to significant wealth accumulation over time. The length of time your money remains invested plays a critical role in this compounding process. In the early years, most of your portfolio's growth comes from your regular contributions and may even feel a bit slow and linear. However, as time passes, the earnings generated by your past returns begin to accelerate. By year 15 of investing $100 monthly, your returns are generating significant earnings of their own. And by year 30, these earnings on earnings often exceed your original contributions and are growing exponentially. This is why starting early is so powerful. It gives your money more time to benefit from this exponential growth pattern. In addition to earning returns on your past returns, investors can also amplify the power of compounding by reinvesting dividends, interest, and other investment income back into buying more shares. Consider what happens when you reinvest dividends from stocks. A company paying a 3% dividend yield is essentially sharing some of its profits with you as a part owner of the business. If you own $10,000 worth of such stocks, you'd receive $300 in annual dividends. Taking this as cash would give you some extra spending money, but reinvesting these dividends purchases additional shares of the stock. These new shares then generate their own dividends, creating a powerful cascade effect. Over time, your reinvested dividends begin earning dividends themselves, potentially turning that same $10,000 initial investment into more than $24,000 over 30 years, assuming a 6% annual growth rate. How compound interest works in practice. Let's break down what happens when you invest $100 initially plus $100 monthly over 30 years, assuming a moderate average annual return of 6%. Year 1, on $300 invested, potential end value $339. Year 5, $6,100 invested, potential end value $7,082. Year 15, $18,100 invested, potential end value $28,931. Year 30, $36,100 invested, potential end value $98,026. The rule of 72. Want to know how long it will take your money to double? Use the rule of 72, a simple heuristic that investors have relied on for generations. Just divide 72 by your expected annual return rate to estimate the years needed for your investment to double. For example, at 3% return, 72, 3, sure, 24 years to double. At 6% return, 72, 6, 12 years to double. At 9% return, 72, 9, 8 years to double. At 18% return, 72, 18, 4 years to double. This rule reveals why even small differences in return rates can have a huge impact over time. An investment earning 6% will double twice as fast as one earning 3%. Historical market returns. Looking at historical data provides valuable context for estimating return scenarios over the long run. S&P 500 1928-2023 average annual total return with dividends reinvested of approximately 10.1%. Dow Jones Industrial Average 1928-2023 average annual total return of about 9.7% EU. NASDAQ Composite 1971-2023 average annual total return of roughly 11.5% 3. However, these returns have not been consistent year over year. The stock market has experienced significant volatility, with some years up and some years down. 4. Best year, plus 146.6%, S&P 500 1933. Worst year, 47.1%, S&P 500 1931. Typical range, 10% to plus 30% in any given year. Comparison of stocks returns with other investment vehicles. Asset Approx. Average historical return. Stocks, S&P 500, 10%. Corporate bonds, investment grade, 7%. Savings accounts, 3.5%. U.S. Treasury bonds, 10-year, 5%. U.S. real estate, 4.5%. Gold, 6.5%. These historical return comparisons demonstrate why many financial advisors recommend a diversified portfolio that includes multiple asset classes. While stocks have provided the highest long-term returns, they also come with higher risk and volatility. The time frame or investment horizon used to extrapolate past returns will vary depending on the specific period or years considered. Potential growth scenarios. Let's examine 3 different return scenarios over 30 years with annual compounding, starting with an initial $100 deposit and $100 monthly contributions. Conservative, 3% annual return. Total invested, $36,100. Final value, $5,814. Total gain, $22,014. Moderate, 6% annual return. Total invested, $36,100. Final value, $92,026. Total gain, $61,926. Optimistic, 12% annual return. Total invested, $36,100. Final value, $308,197. Total gain, $272,097. Practical strategies for saving $100 monthly. Budgeting tips to find $100. Cut one streaming service or subscription, $15 a month. Brown bag lunch from home twice weekly, $40 a month. Reduce utility costs through improved efficiency, $25 a month. Skip 3 takeout coffees weekly and make it at home, $20 a month. Other strategies to find funds to invest include buying generic store brands, buying in bulk, cutting coupons, and cooking at home. Automating your investment strategy. Set up automatic transfers from your checking account to ensure consistent deposits. Use your broker's automatic investment features and dividend reinvestment option to set it and forget it. Automating regular investments takes advantage of dollar-cost averaging to reduce timing risk. Review and rebalance annually or after sharp market moves. Risks and considerations of long-term investing. Market volatility. While stocks have historically provided strong long-term returns, they can be volatile in the short term and even end the year down. The market has experienced significant drops in the past and probably will again in the future. But historical data shows that maintaining a long-term perspective has typically rewarded patient investors. Impact of inflation. With historical inflation averaging around 2 to 3% annually, it's crucial to consider how this affects your investment's purchasing power. This is one reason why stocks, which have historically outpaced inflation, can be an effective long-term investment vehicle. During periods of high inflation, say 5% per year, if you earn 5% on your investments, you effectively have earned 0 in terms of real return. Interest rates. Interest rates directly and indirectly impact investment returns and market behavior. When central banks adjust rates, it creates a ripple effect throughout the economy and financial markets. Higher interest rates can reduce corporate profits through increased borrowing costs, with growth stocks often more sensitive to rate changes than value stocks. Economic cycles. Economic cycles, also known as business cycles, typically progress through four main phases that can span several years: expansion, peak, contraction, and trough. Understanding these cycles helps investors anticipate market movements and adjust strategies accordingly. Over the span of 3 decades, one might expect to experience several such cycles from trough to peak. Global events. In today's interconnected world, global events and geopolitical risks can rapidly impact investment returns across all markets. Understanding these connections helps investors prepare for and respond to international developments that may persist over the next several decades, including increased globalization, climate change, and a shift to green energy. Company-specific risks. Individual companies face unique risks that can significantly impact investment returns, regardless of broader market conditions. Holding a diversified portfolio that includes stocks of several industry sectors, size, geographic proximity, and years in business can help mitigate these risks. Buying and holding a passive investment in something like an S&P 500 index fund can be a cost-effective way to diversify. While economic downturns and bear markets can be unsettling, they often create opportunities for long-term investors. Market history shows that downturns, though painful in the moment, are typically temporary setbacks in a longer upward trend. During these periods, your regular investments buy shares at reduced prices, which can enhance long-term returns when the market recovers. Think of downturns as temporary sales on quality investments. The key is maintaining perspective and staying committed to your investment strategy rather than reacting emotionally to short-term market movements. Research on historical investing returns. Research by Dr. Jeremy Siegel and John Bogle, the founder of Vanguard, looked back over a period of 196 years and compared the real returns of stocks, bonds, and gold. They found that if an investor had started around the year 1810, the New York Stock Exchange was actually founded in 1817, and put $10,000 in gold, their inflation-adjusted portfolio would be worth just $26,000. The same investment in bonds would have grown to $8 million. However, had the investor picked stocks in 1810, he would have turned his $10,000 into $5.6 billion. And stocks are still the big winner if you select a more realistic time frame. Most investors have a 30 to 40-year horizon, not 200 years. Between January 1980 and January 2010, the average annualized growth rate of the S&P 500 was 8.15%. The Dow Jones averaged 8.81% over the same period, while the Nasdaq jumped 9.51% yearly. Bond returns averaged less than 3% between 1980 and 2010. The dollar had an average inflation rate of 3.30% per year between 1980 and 2010, meaning that $1,000 in a savings account in 1980 would have a real value of $2,146.31 in 2010-6. The 30-year period between 1985 and 2015 was even stronger. The S&P averaged 8.73%, the Dow Jones averaged 9.33%, and the Nasdaq averaged an impressive 10.34% per year. 24. What are the tax implications of investing in stocks for 30 years? Long-term investments, i.e. held over 1 year, are taxed at preferential long-term capital gains. Tax rates: 0%, 15%, or 20%, depending on your income. Using tax-advantaged accounts like Roth IRAs can help eliminate taxes on gains entirely. Regular rebalancing can also be used for tax loss harvesting to offset realized gains. Well, what are smart ways to choose stocks for long-term investment? A wise approach to choosing stocks for long-term investment focuses on fundamental strength rather than short-term market movements. Look for companies that have demonstrated staying power through multiple economic cycles, maintain healthy balance sheets, and hold strong competitive positions in their industries. These companies typically generate consistent cash flow and, ideally, share profits with stockholders through dividends or buybacks. For many investors, though, the simplest and most effective approach is investing in low-cost index funds that track the broad market, providing instant diversification and reducing the risk of picking individual stocks. What are the best platforms for automating monthly stock investments? Several mainstream investment platforms have made automated investing both easy and cost-effective. Fidelity and Vanguard, among others, are particularly well-suited for long-term investors, offering easy-to-use automatic investment plans and a wide selection of no-fee funds. Charles Schwab provides an excellent combination of fractional share investing and automation, making it perfect for small monthly investments. And M1 Finance has revolutionized the space with its automated portfolio management and rebalancing features. Robo-advisors are another easy-to-use automated option that can be set up with automatic recurring deposits. The key is choosing a platform that aligns with your investment style and offers the specific features you need, whether that's detailed research tools or a simple hands-off approach. What are the benefits of dollar-cost averaging for long-term investors? Dollar-cost averaging takes the guesswork out of investing by establishing a routine of regular investments regardless of market conditions. Instead of trying to time the market perfectly, you invest the same amount each month, say 100, naturally buying more shares when prices are lower and fewer when they're higher. This systematic approach not only helps manage risk, but also removes emotional decision-making from the investment process. Over time, this strategy tends to result in a lower average cost per share than trying to pick the perfect moment to invest. The bottom line: investing just $100 monthly in stocks over a period of 30 years could potentially grow to a significant sum thanks to the power of compound interest and historical stock market returns. While there are risks to consider, a disciplined approach to regular investing, combined with a long-term perspective, can help build substantial wealth over time.